Good morning. Today we're going to talk about Asana, currently selling for around $19.83 with a $4.4 billion valuation. Current annual revenue is around $630 million. We'll go over some of the financials, the current year-over-year improvements they are having, also talk about some of the operating expenses they are using, especially sales and marketing, and why I believe this stock is undervalued. Okay, first things first, what is Asana? Basically, they are this web and mobile application designed to help teams organize, track, and manage their work. It's this platform that helps on tasks, projects, and workflows. Some of the features they offer are task management, project planning, team collaboration, calendars. So basically, Asana aims to improve team collaboration, productivity, and project management. I always like to start with quarterly data. Again, we're in Seeking Alpha. I'm just going to go ahead and take all this financials right here. So I just exported some of the income statement data and I just put it into this Excel spreadsheet, and pretty much it's quarterly data that's going to show me how they are doing year over year. So I've gone ahead and highlighted some of the main points I wanted to talk about: total revenue, earnings per share, cash flows. We'll start with total revenue. As you can see right here, 8 consecutive quarters of year-over-year growth. During 2022, they had way larger growth rates compared to 2023. If we go ahead and take a look at earnings per share, the past year pretty much, they've grown around 40% on average on the earnings per share. Earnings growth must be supported by sales increases. So current quarterly earnings per share should be up a major percentage, at least 25 to 50% or more over the same quarter the previous year. So their cash flows is where we're going to see some of the biggest improvements: cash flow per share and cash flow from operations. As you can see, from 2021 pretty much all the way through halfway of 2023, they've been posting negative cash flows. Now, one thing to note for young companies is cash burn is a feature, not a bug. With young companies, cash flows will be negative in the early years, and they will always require new equity to be raised and dilution to usually happen. So Asana is only a $4.4 billion valuation. It's a pretty new company. They are early. They will be burning a lot of cash flows. July of 2023 was the first year where they posted positive cash flows. So July of 2023, they posted 7 cents compared to negative 22 cents in 2022. That is a 130% increase in their cash flow per share. And this trend should continue to become positive. Okay, next section of this video, we're going to talk about the operating expenses. I want you guys to focus on this part of the page right here. I try to make it a little bigger, but basically we're just going to talk about operating expenses and their advertising expenses. Okay, so back to Seeking Alpha. I'm going to go ahead and switch it to annual data now. So I'm just going to take the total operating expenses from here all the way till the end of January 2023. Copy that, and we will paste it onto operating expenses under this line. Year over year, their operating expenses are pretty hefty. They're growing year over year. This is actually the first year where there's a decline in their operating expenses. So this is from their latest 10K, and if we read some of the stuff they're saying under operating activities, and they start talking about some of the sales and marketing stuff, here's one of the sections. It says, our primary uses of cash from operating activities are for personal related expenses, marketing expenses, and third-party hosting related and software expenses, and that it's causing them to generate negative cash flows from their operating activities, which they have supplemented working capital requirements through net proceeds from the sale of equity and equity-linked securities. Here's another section in the 10K. So they believe their long-term value as a company will be greater if they focus on growth, which may negatively impact their profitability in the near and medium term. So they do expect to continue to make expenditures on sales and marketing, and expenditures to grow their platform to develop new features, integrations, capabilities, and enhancements to their platform. This is where I'm going to ramble a little bit. So most tech companies are deploying billions into sales and marketing and research and development to grow their future earnings. This is all anchored in sound business logic, but it has an effect of depressing their current reported profits. Investors can't see these returns favorably because of the outdated accounting conventions that we have. So think about it like this. So under GAAP accounting, so they require nearly 100% of research and development and sales and marketing to be immediately expensed, while it allows hard assets like property, plant, and equipment to be depreciated over many years. So when a company depreciates an asset, it recognizes the expense only gradually. So think about all the old economy assets like factories that are considered long-term investments, and expenditures on them can be recognized through the income statement over 20 to 30 years, compared to tech companies who are spending money on research and development and sales and marketing that can't recognize this as an investment. The companies pretty much don't need factories. their biggest investments are in developing and marketing their products. But according to GAAP, most of these expenses must be recognized immediately. All right, so if you could spend marketing dollars today to add profitable customers for years, it doesn't matter if that depresses your current earnings. I'm going to try and illustrate this real quick through the spreadsheet that we have. Okay, so again, we have our operating expenses right here. I just inputted, copied and pasted that straight from Seeking Alpha. Okay, so I'm going to go ahead and just input. So I have in 2021, I have 176 million, 282 million, and 434 respectively. I'm going to go ahead and input these numbers, 434 respectively. 48% of their total operating expenses is used directly for sales and marketing. This is from their latest quarterly reported data, and we go under the sales and marketing, and pretty much that's where it's near. So it's for sales and so they talk about how sales and marketing is around 50% of their revenue. So since Asana is a tech company, think of it as an investment. Again, under GAAP accounting, they're not allowed to write it off. They're not allowed to depreciate it over many years, and they have to expense it during that year. Advertising expenses per share. So pretty much this is just taking the advertising expenses, dividing it by the number of shares, and it's going to give us advertising expenses per share for the last 3 years. Under this section that's a little bit highlighted, it's going to show you earnings. It's going to say earnings per share without the marketing expenses. Let's just assume that Asana is allowed to depreciate their advertising expenses and they don't have to expense this during the year. Let's just assume that we could take these numbers out, but we're just going to go ahead and look at from 2021, 2022, and 2023. These are the most recent earnings per share. So again, this is just advertising expenses divided by the amount of shares. This is going to give you advertising expenses per share. On this last column, it's going to say earnings per share without the marketing expenses. Say Asana is finally established. Say they lower their marketing expenses. As you can see here, their earnings per share have hugely improved. If we take out their advertising expenses alone, they're pretty much hitting 62 cents in positive earnings per share already. With tech companies, you need to watch out for how much they are spending in sales and marketing, and because of the GAAP accounting rules, they are suppressing their earnings. But let's just pretend we could take out their advertising expenses, or they lower the amount of money they spend on sales and marketing or research and development. Asana is pretty much already hitting positive earnings per share. Some other good things why I think Asana is undervalued: they have 530 million in cash and no long-term debt. Well, a little bit of long-term debt, but that's really minimal. Major improvements in their cash flow from their operating activities. They pretty much for the first time hit positive cash flow last year. So we'll see if that trend continues into 2024. Another reason why I think Asana is undervalued is because there's huge insider buying all throughout last year by Dustin Moskovich, which is the president and CEO of Asana. He's also the co-founder of Facebook. But anyways, that's pretty much it. The earnings come out end of this month, so we'll get an update on how they're doing. Let me know what you guys think. Undervalued stock, in my opinion, at a $4.4 billion valuation. I know for some value investors, this might be overpriced, but at a $4.4 billion valuation for a tech company, I do think this is an undervalued, or if it is a little bit overpriced, maybe paying for it at this price would be worth it. All right, we'll see you in the next one.